Welcome to your lesson of the day. Use pre and post market trading to your advantage. Now, if you're like a lot of traders, the notion of trading in the pre and post market where there is less liquidity, where there is more risk, is something that might be a little bit daunting, and I can understand why you might not want to execute at those times. I'm not suggesting that you even do that. What I'm going to talk about is using the information that you get pre and post market to inform your trading and try to get a little bit better. Now, if you happen to trade and you want to trade in the pre and post market, understand the rules at whatever your broker you're at. What types of orders are you allowed to use? Do your stop orders work? Some brokers are not going to have stop orders that'll send any market orders out there, so they will be different conditions between regular hour trading and pre and post market. The same thing can be true for what gateways you might have available to execute on if you have direct market access. It is a responsibility of traders to understand the rules at their broker and then know the circumstances where they can or cannot get filled. So I'm not suggesting you trade pre and post, but I think you can take advantage of that price action. When is the best time to look at significance, pre and post market? When something's actually happening. A stock is reporting earnings after market or in the morning. A stock has significant news. Maybe there is a lawsuit, or maybe there's a new product launch, and you're getting some pre and post market volume with which to work from. That's when you want to dig in, observe that price action, and use it to your advantage come the open. Because what's going to happen is there are traders, and I'm being honest with you, there are traders that are going to log in and look at something like a Robinhood here that had earnings after market, and they're going to see a gap up, and all they're going to do is look at the price action from about an hour before the open and then at the open. So when you come to the chart on Robinhood here and you sit down in the morning, chart, Ram, thank you, you're going to have a gap to the upside. Now, I'm showing you some pre-market action at 6 o'clock, but you're not getting everything in the aftermarket there. You're going to have some support. You're clearly strong. The numbers were all fantastic, and the stock goes for an absolute dump at the open. Well, crap, how could you have seen that coming? Maybe you could, maybe you couldn't. But if you were to look at, I'm going to pull up my trade ideas on a 15-minute and show you a little bit more in depth what happened in the aftermarket for Robinhood, and you might get a sense of why things might have gone the way they did. So as you can see, not earnings, but they had a release of some monthly numbers where they had fantastic metrics, basically blew it out in terms of dollars invested and funds held, and the client counts were fantastic for them. But you're going to see it make a top here just underneath 19 bucks right away after market. This is before 5 o'clock. Then another puts in a higher low, support, and then suddenly it's cresting, and it cannot get above $19. Then you fast forward to early in the morning at 4 a.m. when all the traders start to come online, and that $19 level is your support. I mean, right away. It was resistance into support at $19. If you come into the morning armed with the information that very clearly 19 was a key pivot spot, when it doesn't hold the open, you're not thinking long. Because after that news, you knew there was a brick wall. In a liquidity vacuum, where are the markets getting made? Where is support and resistance? Because this is all on thin volume. So if there's resistance at 19, aftermarket on the release, and then there's support at 19, pre-market for the YOLO traders trading the gap, well, what do you not want to be doing when this breaks 19? Trying to catch a falling knife. You don't want any part of that. So when it breaks this, you can be sitting on your hands or you can be looking for a breakdown short. But then look at where it bounces. Your aftermarket support at 18.25 or so turns into a decent bounce spot. Now here's where it gets a little bit tricky. This is not like at 12 o'clock or at 3 o'clock when a stock hits a double or triple top like an Apple does, and there is tons of liquidity, and to the penny you get a support or resistance level that you can trade off of. When you are looking at that zone of support, it's one thing when it fails 19 to look short and just see momentum down. But if you're looking for that dip support where there was support in the afternoon aftermarket, it's more of a range. You cannot treat these wicks here in the aftermarket like a hard line that it's going to stop at. because there's not enough volume to have that kind of confidence. What you can start doing at those price levels is look for signs of strength. Maybe you get them, maybe you don't. But if you look for like a wick bottom through it and then maybe the higher low, something a little more nuanced where you're not just anchoring yourself to that raw number. That's what I would try to do when you get those pre and post market zones. It's not always going to be the most simplistic trade out there for you to utilize, but you can definitely get out of the way when the floodgates open up. Now the 19 short, I feel like that's a little bit low-hanging fruit and was going to be a good one one way or the other. But that support level that you get put in the aftermarket, it's not going to be the easiest one in the world. All that said, I think you've got to be using those to your advantage. And to give you one more example here with maybe an obvious one, and that's going to be Fisker. Now, obviously, an extreme event happened here, and you should only care about pre- and post-market action if there is an extreme event. In this particular case, Fisker is that candle essentially going bankrupt. You know, they're looking at their options for bankruptcy and what they're going to be able to do, so that's going to be bad news. It's going to gap to the downside. It's going to be complete disaster right at 4 o'clock on this candle. It's a 15-minute. There is a recovery to about 22 cents. And you know exactly what I'm going to get at here. Recovery to 22 cents, support at 17. So what are your key prices? 22, 17. And if you come into the day, now obviously I could show you there or I could show you here in our trading platform. 17 breaks at the open and then right away turns into a resistance level. And it's not just any resistance level. That same bottom in the aftermarket where there was support, when it turns to resistance, there was actually an iceberg seller that broke briefly and then came right back, another iceberg seller. And then look at it hold the line exactly at 17 before falling. Now, if it breaks out here, probably room all the way up to that top level at 21, right? You want to step away from it and don't do anything unless you're going long into the 21 level. So what you do have are levels to work off of that can give you confluence on your trades. If you look at pre and post market, you don't have to trade at 4 a.m. to benefit from price action that happens at 4 a.m. You don't have to try to take entries post market when something has earnings to make money off of the levels that are generated. If you have the patience, and if you have the observational skills and you're willing to wait for some confluence, then you can make these trades and you're gonna have a little bit more confidence because you know it's not just that I'm seeing a support or resistance at 10 o'clock. Well, guess what? Someone was making a market at that price at 4:30 and 5 o'clock on some volume on news, or maybe at 4 or 5 a.m. when the early traders were trying to get a jump on the market. So that's your lesson of the day. Don't necessarily have to trade pre and post market to make money off the pre and post market. Use it to your advantage.